Hello, class. Today we're going to talk about management and accounting information. Again, this is not a substitute for reading the chapter, and the chapter is chapter 15. The first part of the chapter talks about management information systems. Here's what you're going to be responsible for. You should know what MIS stands for, the difference between data and information. Then we're going to get into accounting. How is financial accounting different from managerial accounting? The accounting equation. Then there are a couple of vocabulary words that you need to learn. Asset, liability, owner's equity, GAAP, CPA, and the term liquidity. Lastly, we're going to talk about the three financial statements: balance sheets, income statements, and statements of cash flow. First, for this class, the only thing you need to know is what the acronym MIS stands for, and that's Management Information System. Now, don't be confused. That's not a computer system, although most companies' management information system does include a computer system. But for example, when I worked at McGraw-Hill, part of their MIS was a group of ladies who, by hand, went through newspaper clippings to find out about construction projects. They then entered the information into an actual database. Again, for you should know that the term MIS stands for Management Information System. Now, what's the difference between data and information? Well, if you've already had an intro to computer class, you probably already know this. Data is facts, numbers, names. Information is data that has been organized to inform. So, for example, I might read you a list of names. Totally meaningless, but if I was to tell you, no, that's the Business 150 class at Wayne County Community College District, now it takes on some value. It's useful to someone. It's been organized to inform. Again, data is just facts. Information is data that has been organized to inform. Let's move on to accounting, right? Reporting the financial condition of an organization. The major split in accounting is the difference between financial accounting and managerial accounting. I want you to remember it this way. Financial accounting deals with reporting a firm's financial condition to parties outside the firm, like the IRS, potential investors, and the like. Managerial accounting, as the name suggests, provides information to people inside the firm, like managers, hence the name managerial. All accounting is based on the accounting equation. This is something that you want to commit to memory. Assets equals liabilities plus owner's equity. Now, that equation will always hold true. No matter how large the firm's assets or liabilities grow, that equation will always hold true. The reason it will always hold true is because of something that we call double entry bookkeeping. Double entry bookkeeping says there will be at least two postings for each transaction. They may be on either side of the equation, and on occasion, there'll be two postings on the same side. Again, the accounting equation will always hold true. and it will hold true because of double entry bookkeeping. Now, you need to know what is an asset, what is a liability, and what is owner's equity. An asset is anything the firm owns of value. A liability is anything the firm owes. Now, owner's equity. Usually, it's the money invested by the owner. In a corporation, it's usually the value of the common stock. Owner's equity. Again, assets, anything owned of value. Liability, anything owed. And owner's equity, the amount that the owner invests. Again, in a corporation, it should be the value of the common stock. Now, there's a couple other words I need you to make sure you're aware of. Depreciation. Depreciation is a way to erode the value of an asset over time. There's straight line depreciation and there's accelerated depreciation. For this class, you simply need to know about depreciation. When you get to the accounting class, you'll get to see how they're different. The other terms I need you to know are GAAP, G-A-A-P, and that stands for Generally Accepted Accounting Principles. So, two accountants may report the financial condition of a firm differently, but they could both be correct if they both follow generally accepted accounting principles. An example of a deviation might be, again, we just talked about depreciation. One may use accelerated depreciation. The other may use straight line depreciation, which would give you different numbers. Also, the way you value inventory. You could either use first in, first out, or last in, first out. I don't want you to focus on that for now, because you're going to get that for sure in your Accounting 1 class. But you need to know what we mean by GAAP, Generally Accepted Accounting Principles, and a CPA, a Certified Public Accountant. Now, in most states, there are very strict requirements about who can even test to become a certified public accountant. I believe in Michigan, you have to have either a degree in accounting or so many credit hours and a degree, plus some years of experience. Some states, if you have a master's in accounting, they'll allow you to take the test right away. If you only have a bachelor's degree, you have to put in some work before they allow you to take it. Again, it's going to vary from state to state. What you need to know is a certified public accountant is an accountant who has passed the state exam. You cannot open an accounting firm without at least one certified public accountant. Now, don't be confused. That's not an income tax preparation firm. You don't have to be an accountant to prepare tax returns. But if you have a real accounting office, there's got to be at least one certified public accountant. Another term I want you to be familiar with is liquidity. Liquidity is the ability of an asset to be turned into cash. Now, technically speaking, it's the ability of an asset to be turned into the medium of exchange. For us, that's generally cash. So a liquid asset is one you can walk into the store and spend. That's the most liquid asset. But there are other assets. For example, if you own a house, that's an asset, but it's not very liquid because it takes a while to convert it into cash. Stocks are more liquid than a house because you can go through some things and end up selling your stock and end up with cash in hand. What's the most liquid? Cash. You can walk right in the store and spend it. So we've covered GAAP, generally accepted accounting principles, CPA, certified public accountant, liquidity, the ability of an asset to be turned into the medium of exchange, asset, liability, and owner's equity. Now, the last thing we're going to talk about are the three financial statements. They are the balance sheet, the income statement, and a statement of cash flows. For this class, you need to know that a balance sheet shows a firm's financial conditions, but only for the day that's on the actual statement. It will have a date on it. Sometimes it's called a snapshot of a firm's financial condition because it doesn't take into account any pending transactions or the like. It simply shows what it is today. Same as if you went to the bank and asked, what's my balance? Now, they don't know if you wrote checks and they're pending or whatever. They're going to give you your balance right now. An income statement also shows a firm's financial condition, but it shows revenues and expenses over a specific period of time. It will be a quarter of a year. It might be as little as a month. The period of time will also be on the statement itself. So it may say income statement from June 30th, or let's say July 1st to December 31st, if they were doing them biannually. The last one is a statement of cash flows. For this class, all you need to know is that it tracks cash in your organization. So we're going to wrap up. Major distinctions in accounting: financial versus managerial accounting. Financial is reporting to entities outside the firm. Managerial provides financial information to managers and other parties within the firm. What is the accounting equation? Assets equals liabilities plus owner's equity. It will always be true because of double entry bookkeeping. Vocabulary you need to know: GAAP, generally accepted accounting principles; CPA, certified public accountant; asset, liability, and owner's equity; and liquidity, the ability of an asset to be turned into cash. What are the three financial statements? The balance sheet, which shows a snapshot of your financial condition. The income statement, that shows your financial condition over a period of time. And lastly, a statement of cash flows, which tracks cash in your organization. That wraps up this short video. Be safe and have a great day.